All right, let's talk about something fascinating, something that happens over and over again in finance, a financial bubble. We're going to break down its anatomy, from the exciting start to that famously tragic ending.
And honestly, this quote right here from the legendary investor Sir John Templeton, this is kind of the key to the whole thing. These four words are like the theme song for every single bubble. It's that little voice of blind optimism that has, well, emptied a lot of bank accounts over the years. So let's figure out why that is. So, where does it all start? You might think it begins with just pure craziness, right? But actually no. Every bubble starts with a spark of something real. A compelling story, something genuinely exciting that gets everyone's imagination going.
And you know, the recipe for a bubble is surprisingly consistent. You almost always need a few key ingredients. First, you need some kind of game-changing new tech, think the internet. Then, you throw in a major economic shift, like say all that post-war prosperity. And the secret sauce? Almost always, it's a flood of cheap money from super low interest rates. You wrap all that up in this amazing story that, hey, we've entered a new era and this time it's permanent.
And if you look back, you can see these seeds being planted time and time again. Think about the Roaring '20s. What do we have? Mass consumerism and super easy credit. The '60s? That was a total post-war economic sugar high. Then you've got the '80s, when Japan just flooded its economy with cheap money. And of course, after the dot-com bust, the Fed slashed rates to almost zero, which just set the table for the next big boom. You see the pattern here, right? It's pretty clear.
Okay, so we've got the spark. Now let's talk about how that spark turns into an absolute wildfire. This is the mania phase. This is where that good, rational story just goes completely off the rails. Smart investing? Yeah, that goes out the window. It's replaced by pure speculation. And that fear of missing out, FOMO, it becomes so powerful that it totally crushes the fear of actually losing your money. It's like a virus that just spreads from person to person.
And a classic sign that you're in the mania phase is when you start hearing about one-decision stocks. This idea got really famous back in the '70s with this group of stocks they called the Nifty 50. And the belief was super simple. These companies are just so good, so dominant, so bulletproof that the only decision you have to make is when to buy. That's it. Selling? Shh, only a fool would sell.
And, just look at how nuts things got. Check out these numbers from 1972. Okay, so your average stock was trading at about 15 times what it earned in a year. Pretty reasonable. But then you have Polaroid, trading at 90 times earnings. McDonald's was at 86. These prices weren't just a little optimistic. They were basically saying these companies would have perfect, flawless growth for decades to come. It's like they thought gravity just stopped working on Wall Street.
This quote from Mark Twain is perfect right here. Because if that whole Nifty 50 story is making you feel a little déjà vu when you look at the market right now, well, you are definitely not the only one.
The comparison is just, wow, it's so striking. Back in '72, you had the Nifty 50. They were these dominant, bulletproof companies that made up almost half the market. Fast forward to today, and you have the Magnificent Seven, these huge tech giants that make up more than a third of the S&P 500. And listen to the story. It's the exact same one. These companies are untouchable. Their growth will never, ever stop.
And this chart really drives the point home. It's just so telling. You have just 7 companies holding up a huge chunk of the entire stock market. This is exactly what a top-heavy market looks like. And it's the same kind of structure we saw right before that whole Nifty 50 thing came crashing down. Which of course brings us to the, let's say, dramatic part of the story, the pop. Because here's the thing. It doesn't matter how cool the technology is or how great the story sounds, the ending for a bubble that's fueled by pure mania is almost always the same. And it's never pretty. It's sudden, it's brutal, and it is absolutely inevitable.
Just think back to Black Thursday 1929. You just had a whole decade of parties, jazz, and stocks going to the moon. And then, bam, reality hits. The market falls 11% in a single day. That was it. That was the moment the party was officially and violently over. Or what about 2008? The collapse of Lehman Brothers? That wasn't some slow leak. It was a bomb going off. It literally vaporized $600 billion overnight. It completely froze up the credit markets and sent this massive shockwave across the entire planet. Yeah, the pop is never gentle.
And the devastation that came after that initial shock, it was just unbelievable. Between 1929 and 1932, the Dow Jones didn't just have a correction. No, it was completely obliterated. It fell an incredible 90% from its high point. We're talking about people losing everything, their entire life savings, just gone.
So whatever happened to those bulletproof, one-decision stocks, the Nifty 50? Well, Polaroid, the tech darling of its day, it collapsed by more than 90%. And even the great ones, the ones that are still around, like McDonald's and Coca-Cola, their stocks fell over 70 and 60%. And this wasn't some quick dip in recovery. Nope. It took 8 long years for the market to get back to where it was. And that brings us right back to today. Full circle. We've got a revolutionary new technology, we've got a flood of money pouring into it, and we've got that familiar story of a brand new era. So we have to ask the question, right? With this massive AI boom, is history rhyming all over again?
I mean, get this. This is a quote from the CEO of OpenAI, the company right at the heart of the AI revolution. He's basically admitting that they actually lose money on their paying customers. Think about that. The more popular their product gets, the more money they lose. It's a shocking disconnect between all the hype and the basic reality of the business.
And then there's this number. To even begin to justify the crazy high prices of AI stocks today, the whole industry would need to spend almost $7 trillion just on infrastructure by 2030. That's not just growth. That's what they call a hockey stick curve. It's explosive, almost straight-up growth. It's a massive bet on a future that, well, might not ever happen.
So that leaves us right where we started, with the ultimate question, the one that echoes through every single boom and every single bust. When you look at the patterns, when you look at the psychology of it all, and you see these staggering numbers, I'll just leave you to think about those 4 most expensive words in the English language. Is this time truly different?